Good. Good afternoon, everyone. Welcome to the latest in the Tax Analyst series of discussions on key issues in tax policy and tax administration. Today's debate is about marking securities to market and House Ways and Means Committee Chair Dave Camp's recent comprehensive tax reform discussion draft. I'm Chris Bergen, the president of Tax Analysts, which is a nonprofit publisher of Tax Notes Today, State Tax Notes, and Tax Notes International, and many other fine print and online products on federal, state, and international taxation. We are in our 12th year of public discussions on tax policy. If you're new to our discussions, let me say it's great to have you here. Let me take just a moment to explain our process today. I will open things up with some brief remarks to introduce our topic. I will then introduce our distinguished panel of speakers here. Each of them will address aspects of our topic. After that, we will open up the discussion to all of you, and we encourage you all to participate. We are streaming live video of this event on our website. That explains the camera in the back of the room. So I want to welcome our virtual audience as well. We've now added a Q&A feature on our site that will allow the online viewers to submit their questions throughout our discussion today. For all media purposes, we are on the record. For that reason, when I recognize you, please tell us who you are. Once I call on you, if you're in the room, we will quickly get you one of our handheld microphones. We are also live tweeting this event at #MarkToMarket, no hyphens, as we reach more people beyond this room through social media. We invite our online viewers to send us questions via Twitter. Just tweet at #MarkToMarket, and we hope to hear from you. Two of our panelists, Joram Keenan and Viva Hammer, have provided written material on today's subject. Joram's paper is included in this week's tax notes, which I hope everybody grabbed, and Viva's JCT documents are available at the registration table out front. We've made them both available on our website as well. We will also post the webcast and a transcript of today's event next week on our website, taxanalyst.com. Before we get started, I would like to extend a special welcome to members of the American Bar Association, the American Bankers Association, the New York State Bar Association, and the New York State Society of CPAs. Now, on to the subject at hand, marking securities to market. When some people hear mark to market, they think of Enron. That company abused mark-to-market accounting and other accounting rules. Or they may think of the 2008 financial meltdown, when some legislators demanded and got regulatory changes because mark-to-market accounting made insolvent banks look bad. We're not here to debate the merits of mark-to-market accounting for tax purposes. That debate has largely been settled. There are no better numbers. For those of you too young to remember, or like me whose memories are fading, back in 1997, the IRS abandoned a $2.5 million project to have the Los Alamos National Laboratory produce derivatives valuation solution. Seems the rocket scientists couldn't come up with anything better than the commercial software. So the project went bye-bye. We are here to talk about whether other taxpayers besides dealers should be required to mark derivatives to market. For context, let me give you a chronological snapshot of mark-to-market accounting in the tax law. In 1981, Congress required exchange-traded futures to be marked to market by all holders. This rule is specific to the contract. In 1993, Congress required securities dealers and electing traders to mark their trading books to market. Securities include derivatives. This rule is specific to the holder. Then in 2003, the Bank One case inspired the IRS to allow dealers to use their book numbers when they mark derivatives to market. Also in 2003, the FASB required all holders to mark all derivatives to market unless they are part of a hedge. In 2008, in the wake of the financial meltdown, accounting regulators let banks reject so-called fire sale prices for beaten-down assets like mortgage-backed securities. In 2009, under threat from Congress, accounting regulators allowed banks to use significant judgment, internal models, and cash flow in valuing beaten-down assets. This damages mark-to-market accounting and boosts bank earnings. In 2010, the Dodd-Frank Act required derivatives, including credit default swaps, to be cleared to the extent feasible. Insurance companies objected to the implication that derivatives must be marked to market, so a separate change removed them from Section 1256. In 2011, Treasury, goaded by the Section DFA change, defined notional principal contracts to include credit default swaps, removing them from Section 1256. So in 2013, House Ways and Means Committee Chair Dave Camp put out a draft suggesting that all holders mark derivatives to market unless they are part of hedges. And that brings us to 2014, when Camp put out the tax reform proposal. So, to kick off our discussion today, we will introduce the politics of mark-to-market in tax, examine Camp's derivatives plan in detail, and debate the merits of marking certain types of derivatives. To do so, we have put together an excellent panel. I will introduce them in the order in which they will speak. Our own Lee Shepard is a contributing editor at Tax Analyst. Joram Kenyon is a partner at Carter, Ledyard, and Milburn, LLC. And Viva Hammer is legislation counsel at the Joint Committee on Taxation. Thank you all for coming. Lee, would you get us started, please? That's working.
It's okay. So I'm going to talk about financial accounting for a little while by way of introduction to the Camp proposal. And we have to think about, what are derivatives and who is using them and why are we wanting to mark all these things to market and why does financial accounting require this? My personal definition of a derivative is that it's a contract that takes risk from somebody who's got it and moves it over to somebody who doesn't know that they're assuming it. And once you start thinking about it that way, then you say that, some of the questions that tax people view as marking problems really are kind of regulatory problems and really should this holder be playing in this sandbox? I went to a banking conference the other day, and a guy was on a panel who was from one of the big systemically dangerous financial institutions, and this one wasn't a bank. And he says, "Whoa, we don't use derivatives for speculation. We just use them for risk management." And he says that he's got a $300 billion book of derivatives in notional amount, which is a fairly scary number. But really, all sophisticated holders of these contracts have a marked book somewhere, even if they're not a reporting company, because you cannot do this without knowing, what your position is on a pretty regular basis. But, what I want to talk about here also, in my introduction is, what is it that bugs lawyers about this? Because there's a lot of, people, we really do say mark to market, and they say, oh, no, Enron, oh, no, we can't do that. Lawyers sometimes think that, well, assets have intrinsic value. Now, and they don't. I mean, if you look at your wedding ring, what's that thing's intrinsic value? It's the gold bullion value. Well, when you take it to the pawn shop, the guy looks at the daily gold fix before he weighs it. That's a market. He's getting a market price. Nothing is valued at anything that anybody, that isn't what somebody in a market is willing to pay for it. And valuation is also a temporal concept. So yes, on one day your wedding ring is worth, $50, and on another day it might be worth $70. And that's why when in financial accounting, when we talk about fair value, we talk about fair value on the measurement date. The definitions of financial accounting and financial accounting's fair value, okay, and the tax law's fair market value are pretty similar. I mean, there are differences, but they're not really material for what we're talking about here. And here's other things that make lawyers uncomfortable. Accounting uses a lot of estimates. I mean, accounting says you have to price things that are hard to price. When you've got a gas station and you've got a brownfield under the gas station and you know that there's just going to be some horrible liability out there, tax accounting will not let you recognize that because it's not all set in stone and you haven't been sued in a judgment and you're making the payments and stuff. But financial accounting will say, you need to put a price on that and you need to take the hit for that right now. The other thing that financial accounting does, and this is an example of that, accounting recognizes losses earlier. And this makes lawyers crazy. But you gotta do it. because you need to know where you are, and lawyers are going to have to get comfortable with recognizing the losses earlier. I mean, the financial numbers are not some funny little parallel universe in and of themselves. These are numbers that everybody in the world is using on a daily basis. Now, in financial accounting, derivatives have to be marked to market unless they're part of hedges, and they have to be shown at fair value. The changes, the marks, go to the income statement, and there are levels of how you value things when you don't have markets. In financial accounting, this is called the fair value hierarchy, and we have a nasty little, sort of pejorative joke about it, that level 1 is mark to market, and level 2 is mark to model, and level 3 is make it up. But, since the 2008 episode, when people were allowed to throw out marks they didn't like, and bids they didn't like that were real bids, things have gotten a little better, and there's new guidance that says even when we're in level 3, we have to hook things up to what are called observable inputs, which is sort of the accounting lingo for the known knowns. So when you've got a market, and when we're in level 1, we've got a market for the contract. It says you've got to go find the principal market for the contract. It says you don't have to run around beating yourself up looking for every market for the contract. But if you've got an active market, you got a mark to bid. In level 2, the lingo for model is valuation technique. But your valuation techniques are not supposed to represent what are euphemistically known as unobservable inputs. Unobservable inputs are like the unknown unknowns. You're not supposed to have you're not supposed to make stuff up. You're not supposed to slap yourself in the stomach and say, well, I think this is worth today. Your value, the inputs to your model have to reflect market conditions. Then when we're down in level 3, you still are saying, look, those unobservable inputs, those have to be minimized. Your objective here is to get your exit price from this asset. And that means that if you're going to use unobservable inputs, that you have to use ones that market participants would use. So if we think about, what sort of inspired all this, this was the Lone Star purchase. Lone Star was a private equity fund. In about 2007 or so, it bought a bunch of AAA top tranche collateralized debt obligations from Merrill Lynch. Okay, this was not a fire sale. It was a widely reported sale, and it was 22 cents on the dollar. And this absolutely flipped people out, and that's when they went to the accounting regulators in 2008 and 2009 and said, oh, we have to be able to ignore fire sale prices. Oh, we have to be able to say, this is not an orderly market. You don't want bank books to, look bad. You don't want us to look insolvent just because we are, And you can't sit there and say, that's all over, because, it's not just sophisticated holders like banks that have level 3 assets. There are level 3 assets. Remember my definition of a derivative. It's going to be held by somebody who doesn't realize they're holding this risk. There are level 3 assets on the books of institutions that are ultimately answerable to widows and orphans. This is and these folks need marks. They should be marking stuff, and perhaps they, as we said before, they should not be playing in this sandbox. So then we get over to, we're done with financial accounting pretty much here. We start thinking about, well, what kind of power does the Treasury have in this realm? And the Treasury's accounting power is comprehensive. The Treasury's accounting power is so huge that there have been people in government trying to make rules this way who just don't realize how huge this power is. When we look at the statute, we see 446B. 446B is the clear reflection of income power. Now, what does that let you do? In the case law, anytime we're dealing with a timing question, it's an accounting method in the tax law. That means anytime there's, just timing of recognition of something, that invokes that power. It says that the tax administrator can take a taxpayer off of a permissible method and move them onto another method, even if it's not even a legal method, if the permissible method doesn't clearly reflect income. Now, if the taxpayer's on a permissible method and the commissioner thinks it's a little screwy and maybe this other method here would be better, you can't do that. It's not a better test. But the clear reflection says unless what you're doing is arbitrary and capricious, you can move somebody onto another method. But then, it's kind of funny. When you look at the statute, we've kind of forgotten what's going on in that statute because the statute itself starts with the taxpayer's books and records. It says, what is the taxpayer doing for book? You can use that for tax. The taxpayers we're talking about with derivatives, if they don't have marks, they should not have derivatives, full stop, okay? So really, the Treasury has the power right now to require derivatives to be marked, and we've sort of been tiptoeing up to that because you have the 2004 regulations for contingent payment swaps that sort of creep you up toward marking, and then you have these 2011 proposed regulations that, they look like they're kind of prepping for marking. They're looking to that, and there is the power to do that. So then, when we get over to the Camp proposal, which we're going to right now, what's going on is Camp is sort of preempting the Treasury on something was sort of on a train that was coming down the tracks, to mix our metaphors here. And Camp is also trying to bring things closer to financial accounting. Now, you can sit there and say, well, I don't like financial accounting results, or financial accounting is not ideal. But this stuff's in place, and this is what people are doing, and they have books, and this, it's hard enough to get to these numbers. Why are we going to prepare a whole nother set of numbers on derivatives when we've got a perfectly good set of numbers that we're not going to get a better set of numbers? Camp is saying, okay, we're marking all derivatives regardless of the holder. Then when we get to start, we are marking them even if there's some other section that would prevent that gain or loss from being recognized, because this marking proposal is an override. All the gains and losses would be ordinary. Now, it may be that you really do need a statutory change to that, but to make that happen, but you don't need a statutory change to force people to mark. All these ordinary gains and losses would be treated as attributable to a trade or business that helps individuals. When we start thinking about what would be marked, we're marking everything, basically. Derivative includes everything that we think of as derivatives. It also includes indexes that aren't economic indexes. It includes options. It includes naked credit default swaps. It includes embedded derivatives, and this gets tax lawyers all excited, but in financial accounting, you do have to dig out that embedded derivative and mark the thing. And so what this does is brings tax accounting closer to financial accounting. It says if you're in a straddle, both sides of the straddle would have to be marked. So to a tax lawyer that says, oh, well, heavens to Betsy, everything is a mixed straddle. But what's hedging? Hedging's a mixed straddle that's got a business purpose. And when you're in regular accounting, if you've got a fair value hedge, you are marking both pieces of it. In the tax law, when we give you hedge accounting and when we exempt it from marking, what that means is, well, you can use a reasonable method to sort of get integrated treatment for these two pieces. But when you get right down to it, the most reasonable method is marking both sides. It also says that the referenced asset or the contract itself, one or the other, neither of those has to be publicly traded. So we were talking about those level 2 and level 3 assets that I was talking about. Those have to be marked. It says, well, for numbers, we prefer your GAAP books, or we prefer whatever you've reported to the SEC. But you do have to be consistent in your valuation methods. We have, how am I doing on time here? We have
Still okay.
Yeah, okay, we have a slug of exclusions here. Basically, when the 2013 draft came out, a bunch of people went in and whined, and so Camp excluded all these things. So we have all of the various funny securities that we have OID rules for have been excluded now. Repos have been excluded. Real estate that's inventory is excluded. Compensatory options are excluded. Insurance contracts are excluded. What else? ADRs are excluded. One of the things that's fun about the exclusions is you see that we live in a world that's awash in primitive sorts of derivatives, and so when you really go to define derivative in a principled, comprehensive way, you pull in all this stuff like compensatory options. Lots of executives get shadow shares, phantom shares, that's a derivative. You get a payment based on the share price. That's a derivative. When we get over to hedges, the Camp people want to simplify hedging because we got two different definitions of hedges. The tax definition says you have to identify the thing and say it's for risk management. The financial definition says it has to work. And you have to keep retesting it to make sure it works. But you can hedge anything. You can have what tax people call Hoover hedges, you can hedge tax flows, you can do whatever you want. But you do have to keep identifying, you do have to keep testing it to make it work. So what the Camp proposal does is it says, well, if you've identified it for GAAP, then you can identify it for tax, and we have comprehensive treatment here. So what we see is a whole thing that just really, to the extent possible, takes our financial accounting and moves it over to tax accounting. And, when we think about, there's different purposes for the two kinds of accounting, really, when you think about it, they've gotten way too separate in this area because there's really, I hate to sound like, of course I'm in Washington, I can sound like that, there is no alternative, but there is no alternative, to doing this. Thank you.
Thank you, Lee. Joe Rum?
Okay, so I'm actually going to step back for a minute and tell you, and my views are pretty much consistent with Lee's views and Viva's views. Even though we haven't heard Viva speaking, I know that I've known her over the years. So I think we're not going to be too much apart, but I'm actually looking at this from a slightly different perspective, more of the practical perspective. So stepping back for a minute, what I've tried to show in my paper, and I've been saying it for years, it was also an older paper in 2007, is taxation of derivatives in the United States is a big mess. And it gets worse every year. Here is why it's a mess. Because we have, start with timing rules. We have timing rules that are based on the identity of the instrument. For example, the NPC, the National Principal Contract Regulations, 1256, focuses on what the instrument is. And of course, each of them provides for different kind of treatment. We know the NPC rules talk about periodic, non-periodic, and termination payment. Each of these has separate type of timing rule. Then we know 1256 is marking to market only specific types of derivatives. Then we have timing rules that are based on the identity of the holder. Section 475, we're focusing on dealers required to mark to market, and traders can elect to mark to market. We have timing rules that are based on the purpose of the transaction, the hedging rules. And to add to this, we have timing rules that are based on any abuse rules, or the famous constructive sale rules, and similar, of course, wash sales rules, and also Section 1260. So all of these provisions are timing, restrict the timing, whether they disallow or defer losses, or accelerate gains one way or the other. So this is just timing. Now, when you add character to it, we also have a big mess with respect to taxation of derivatives. So once again, we have character rules that are based on the purpose of the transaction, the hedging rules. We have character rules based on what the instrument is. 1256, there we have this really weird 60-40 rules for derivatives that are subject to 1256. We have character rules that are based on what is the underlying of the derivative. All the option rules of how do we tax, what's the character of again, sale or other disposition of derivative or other gains. It's based on the underlying. Now, of course, we have 1234 cap A. So, and we have, again, any abuse rules that relate to character and, for example, the section 1258. So what it brings out, the reason I believe that mark-to-market is actually more of a practical solution than a theoretical or the best solution is because marking-to-market would actually consolidate timing and character rules for derivatives. And you'll have to forgive me, I'm just focusing here on derivatives. I'm not saying, Chris started with saying mark-to-market for securities. I'm not going to bore you with Haig-Simon's definition of what's the, what's the most superior way to tax everything in the world, and or what is the theory and the justification for marking all assets to market. I'm really focusing here on derivatives, and I say that we need, and Lee said there's no other alternative, I agree. We need a coherent and comprehensive set of rules for taxing derivatives. And I'm not just saying, by the way, one of the things I'm criticizing in my article is that the Kemp proposal talks about timing, it talks about character, but it neglects to talk about source. So this is another area where we would have to make a determination. I don't know how many of you are familiar with the fact that we do have, Congress actually gave Treasury the right to determine source rules for derivatives. It has never been used. I'm not talking 871M. I mean, we do have, Treasury and IRS do have the right to determine source of derivatives. So this is just aside from the discussion. I don't want to start talking about source here right now, but I propose to have a comprehensive set of rules for derivatives where the timing rules will be set as marking to market, with exceptions that I will discuss in a minute. On the character side, I'm actually proposing something even more comprehensive than what Kemp is suggesting. What Kemp is suggesting is that only the mark-to-market gains would be ordinary. I actually think that all gains and losses from derivatives, regardless of how you name them, regardless of when they are realized, beginning, during the term, or in the end, everything that relates to a derivative, every gain or loss would be ordinary. So if you're scratching your head and said, how can you do this? We've done it before. What about CPDI rules? All returns on a CPDI is ordinary, including sales. So it's not unheard of that whether we do it by Congress, Treasury, or the IRS, there will be a determination that all returns on derivatives will be ordinary, regardless of whether they are accepted for mark-to-market or not. Now, going into timing, marking to market, I generally agree that it's time to mark derivatives to market. We started with this back in 1981, and when Congress originally thought about marking to market, the original purpose of the 1981 Act of Section 1256 was we're marking futures to market anyway for business purposes and for accounting purposes, right? We're marking futures to market because the two sides can withdraw their gains and have to put more margin, so it's really effectively marked to market. No liquidity issue and no valuation issue because these are exchange traded. Now, shortly thereafter, Congress added a few other types of instruments and derivatives that not necessarily would be as easily valued and not necessarily will be marked to market for non-tax purposes. So Congress gave up on the liquidity argument relatively easy between 1981 and 1986, where they expanded Section 1256. And later in 93 came marking to market for dealers and then electing traders. And as Lee mentioned, 2004, we had a proposal to tax contingent swaps and allow for election to market. We have somehow some mark to market under Section 1297 for PIFIX. But generally, Congress, Treasury, IRS, everyone's open for the idea of marking to market. And I generally believe this is the right answer and more or less consistent with what Kemp is proposing. My only concern, and again, from serving clients in the last 13, 14 years, is that we would still have to worry about valuation. And this is why maybe I sound too much mainstream, and I think what I'm saying is consistent with the New York State Bar, the American Bar Association, and plenty of other commentators, to maybe limit the first phase to instruments where you can either value the instrument itself, the derivative, easily, or at least as a substitute, value the underlying, if it's a single underlying, or a narrow index. But I am suggesting that in a couple of years, well, not in a few years, there'll be an evaluation or reevaluation of these exceptions. And if the mark-to-market system is working as it should, then Congress should reevaluate whether they may want to expand it to more derivatives. So I'm not saying that we shouldn't move to a comprehensive mark-to-market. I'm just saying we need to do it in steps. So therefore, my suggestion, consistent again with, as I said, many commentators, is to limit the mark-to-market to publicly traded positions or positions where the underlying is publicly traded. I want to mention briefly the embedded derivative proposal, which I think economically is an excellent proposal, because this is really, I mean, when I teach my classes, Georgetown, Michigan, I always say that economically convertible debt and investment unit, they behave the same, but they're treated differently for tax purposes. So I agree that the convertible debt does have an embedded derivative. We all know that. And if this is a derivative and we're marking all derivatives to market, there should be no reason why we would not mark the embedded derivative to market. But I would caution, though, I mean, everyone needs to understand, you got to believe that when you have a convertible debt, in order to market the embedded derivative, someone has to know how to pull this derivative out and how to value it in order to mark it to market. And I challenge each of one of you to look at even the most, again, public deals, the deals with the the large issuers, and tell me how many people really can do this valuation. Now, you would, of course, the response would be, wait a minute, don't you have to do it under FAS 133? Some embedded derivatives have to be accounted.
Topic 820.
What?
There was.
Yeah, I know. I'm always saying, well, FAS 133, it has been.
Topic 820, folks.
But my point is that I'm not sure that the compliance costs of having to extract this embedded derivative from a straightforward plain vanilla convertible debt and marking it to market, I'm not sure that the benefit of doing it so would really outweigh the compliance costs. So
why not? If they're already doing it anyway.
It's, well, let's think, who's they? I mean,
They is reporting companies, and they is a lot of holders who are not reporting companies but have a mark book.
So that's going back to my proposal. Yes, I agree, and this is one thing I also agree with respect to mark-to-market in general. Yeah, if someone is marking to market for books, anything that you can call it in the world, you know what, I'll even be generous, said, let's talk about beyond derivatives. Anything that's being marked to market for books for years, and whoever is marking it to market has a reasonable valuation system, could actually transport it into tax. Now, I would challenge the people of Parliament, we have more than a handful of IRS and Treasury people. when there was the 2003 Bank One, and then came this proposed rulemaking, and then there was several years of gap there between the proposed rulemaking and then the proposed regs. In fact, the court in tax in Bank One suggested, let's just conform books and tax. The IRS said, whoa, whoa, wait a minute, it's not that easy.
Actually, the court came up with its own
Yeah,
method, and the IRS said, taxpayers, you can use your own numbers if you can tell us that
Well,
those are real
no,
book
there was a grocery list of differences and where you can and where you cannot in the proposed rules. So
You know, I understand.
I'm in favor. I mean, and back in 2004, I said, let's just conform everything. So if the IRS is telling us, or Congress would mandate it, say, let's allow books values to use for tax without caveats. We don't care about the different roles of accounting and tax, because this was what the IRS focused about, and the court also. If we allow for full confirmation, full tax and books, then I say that we can go to a broader kind of mark-to-market. But the more limitation we impose on even those holders, those users of derivatives that do mark their derivative to market for accounting purposes, the more restrictions we impose on them to actually use these values for tax, the more complicated it would be. Now, what about all these that don't even use it for books? I mean, we do know that many, I mean, at least...
When I say somebody has a marked book, they've got them for internal purposes, even if their regulators aren't asking for it, because they know they need those numbers. They need to know what's going on.
I mean, I challenge you to point out for me an institution that regularly uses derivatives and doesn't have a marked book.
Excuse me, just there's plenty of time that we can engage.
Actually, I would like to answer
You
this
want to just
challenge.
go and engage now?
No, yeah. I would... There are a handful, well, actually a handful, I'm sorry, used the wrong term. There are plenty of entities, of traders, of hedge funds,
That
users
don't mark?
that don't even know how to value them. Because I know I get these calls on a weekly basis. So for example, where do I get these calls from? Just as an example. Actually, I get these calls when a trader, a hedge fund, and even the larger ones, want to go to ask me about should we make the trader election. And we talk about trader election. By the way, you'll be surprised how many recently have started to move to a trader election just so they can, treat everything as ordinary. So then the next question is, how do we do the valuation? And I would tell you, though, yes, some of them would work with the big four accounting firms, and some of them would have a solid valuation mechanism. Others do not. So
they're not marking for reporting or for their shareholder or their partner values. They're not marking at all.
If they're marking, it's so not accurate in terms of it's very based on a lot of assumption, presumption, and a lot of shortcuts. So once again, if IRS comes with guidance to say we're going to help you, all these users on the borders that do want to mark to market, they do have some mark to market, whether it's reporting to their investors, whether they are actually under GAAP or I guess IFRS pretty soon, and they use reasonable methods, then the IRS takes the next step and says, okay, tell us what you use for books or regulatory or business or reporting purposes, and we will allow you to use it for tax. At this point, I think that we can definitely move to something much more comprehensive. But I'm telling you from someone from the practice, and there are quite a few here, I saw some of the names I recognize that have dealt with the same issues. And not everyone in the world is really familiar with how to value these derivatives. I mean, Lee mentioned earlier that there's always, not always, but very frequently, there's one party to a derivative that doesn't even know what they entered into. You think such users would know how to extract the embedded derivative from a convertible debt that they purchased and mark it to market? They might be able to do it, but then the compliance costs will outweigh the benefit of saying that, okay, we're marking everything to market because Haig Simon said so 100 years ago.
Well, you could, I mean, and one of the things I forgot to mention is you could have a consistency rule that says that the dealer has to give the customer a mark. The only issue with that is that the dealers don't want that because they don't want to tell the customers what they're doing. But you could do that. You know, you could say dealer has to give the customer the numbers, and everybody has to, you know, report the same number.
So I'll ask Carl Wiley then. There was a suggestion about 871M. Let the other party tell us what they're doing. I mean, no one likes it. No one wants to have the dealer, the other party to any deal, tell the holder, the counterparty, or the buyer side in this case, what to do. Because quite honestly, if you're buying a derivative from a dealer, you guys are on the opposite sides. So not necessarily what the dealer does, you want to do the same. Though we know that in the case of a debt instrument, normally the issuer puts together the OID schedule, and whether if it's a CPDI, they send it to the holders. I think at this point, even though there's still some, I would say, not consistent interest between the two parties, you can still live with what the issuer said. But if I'm on the user side, and I need to use the valuation that the dealer is telling me, I'm not sure that I'll be comfortable with this, or at least advise my client if that's what they're asking me to do. So there's got to be something better that would allow users to do their own valuation for their purposes.
Thank you. Okay, Viva, I'm going to really try to give you the 15 minutes I promised you, and then we can engage. So.
I'm starting out that I'm not speaking on behalf of the Joint Committee on Taxation, nor am I speaking on my own behalf. I'm speaking on behalf of my children and your children who will live with the tax code far longer, I hope, than we will. Mm-hmm. The income tax has made a problem for itself. It wants you to measure your tax obligation every year at the gong of a bell that rings at the same time each year. But some things the tax law calls income doesn't answer to the gong of a bell. They happen whenever. And the tax system has to decide what to do about income that behaves in a whenever kind of way. Most wages are paid at the gong of a bell, and most people eat their wages, and they can't put off their hunger too long. So wages that feed people are taxed at the gong of a bell. Taxes on wages constitute the vast majority of the tax receipts of the United States, about 70%. It is a great luck to the tax system that people who eat what they earn still walk on the earth. Then there are increases and decreases to wealth, which is a kind of income, that don't feed hungry mouths and can be made to happen at any time. They can be deferred or accelerated, they can be hidden, and they can be made to disappear. And the tax law has a hard time deciding whether to tax these changes in wealth, when to tax them, and how to tax them. And so, mark-to-market. Mark-to-market is a tax gong for transactions that generate cash at odd moments, whenever it's convenient for everyone. If people entering into derivatives can ensure they'll collect cash with interest, then they mostly don't care when they receive it, especially if changing the day of receipt saves taxes. Take, for example, a swap. A swap normally requires payments of amounts on a regular schedule. But as long as collateral is posted and rights can be enforced, a party can pay its obligations at the beginning or at the end, or every second Tuesday except if it's a British bank holiday. Then the tax law needs to decide if the payments should be taxed when they're paid or at some other time. Take, for another example, a forward contract. Usually a payment is made at the end of a forward contract. Then people invented prepaid forwards and variable prepaid forwards so that parties to the contracts have total control over when they receive payments. If everything else is equal, it shouldn't matter which year a tax is paid. But everything else is never equal. And Congress cares when tax is paid, just like I care when I'm paid by Congress. It doesn't like taxpayers sharing their income and losses between each other, nor does it like taxpayers moving their income and losses backwards and forwards in time too much. But derivatives allow taxpayers to reduce their taxes by timing when they recognize income and loss, for example, to use up net operating losses or expiring capital losses. So plebeians like me pay taxes regularly on the easy target of wages, and the others choose when and how much tax they pay, if they know how to arrange the bits and pieces of tax rules to suit them. And even when Congress decides to advantage one type of income over another, for example, long-term capital gains over wage income, it doesn't intend to let people opt out of tax altogether by using complex transactions for which the tax rules are unclear, like bullet swaps and prepaid forwards. And so, mark to market. When you mark something to market, you pretend you sell that something at the end of your tax year for the value it would have gotten if it had really been sold. It's a fiction that makes sure when you hear the gong you pay your tax, or at least calculate how much tax you'll be paying the following year. People always complain about mark-to-market the same way, that they don't have the cash to pay the tax, that's called liquidity, and they don't know what price to use in the pretend sale, that's called valuation. As to the first complaint, liquidity, mark-to-market is just another example of a rule that makes people pay tax even when they have no cash, such as the original issue with discount rules. OID has been in the code as long as I've been on the earth, which is to say a long time, and no one has lost life, limb, or good business over it. Neither has any securities deal lost life or limb over marking its portfolio to market. As to the second complaint, valuation, which price to use in the pretend sale, for that we can look to every financial discipline around. It's simply false, specious, and disingenuous to say you don't know what mark to use. Tax is the last of the game, the least marking financial profession. The accountants are required to mark a vast number of things. The risk managers, the regulators, everyone marks. There are taxpayers already using mark-to-market because they refuse to create a whole set of new calculations for their tax when book was so easy to rely on. I used to argue with my clients about the fact that they didn't have to mark or they shouldn't mark for tax when they wanted to. People use gestimations all the time, for example, for estate tax, for like-kind exchanges, and for charitable donations. It's part of the tax law. And I have a challenge for the naysayers. Taxpayers and the IRS, get your mark-to-market wrong. Do it. Try it. Because 3 years later, you're going to have to justify how you got that number on the tax return when the end result turned out to be so different. Get it wrong. The marvelous thing about mark-to-market is that it's self-correcting and fast, unlike the estate tax. Tax is moving in the direction of everyone else, but slower. If tax doesn't want to be left behind, mark-to-market is inevitable. More and more things have been required to be marked for the last 33 years, which we got a nice summary of at the beginning. The chair of the Ways and Means Committee, Mr. Camp, decided early in his meditation on tax reform that financial transactions were a poster child for disorganized tax law in need of good policy. The taxation of derivatives have not been addressed in a coherent manner by Congress, and the laws are all over the place. Not only does this state of affairs lose money for the Treasury, it does so in a way that is not fair to taxpayers, both those who use derivatives and don't understand the laws, and those who are paying taxes on wages and have no opportunities for planning, the ones who bear the heaviest tax burden, the 70%. So early in 2013, Mr. Camp released a discussion draft proposing mark-to-market for derivatives, only derivatives, not stocks, not bonds, not your house, not your car, nothing else. The tax community had talked so long about this idea, it was almost a homecoming, but also a surprise. Would Congress have the courage, the vision to implement this? People enjoying the benefits of the current unfair, disorganized system got upset. Nevertheless, after significant revisions, the Ways and Means 2014 tax reform also required mark-to-market for derivatives. So now I want to ask Mr. Camp some questions, and I hope he's watching the video. What do you do with the premium on options? Is it included in the mark in the first year the option is written, in the year the option ceases to be, or should the premium be spread over all the years the option is in existence? Number 2, have you proposed the best way to tax hybrids, contracts that combine elements of derivatives and non-derivatives? Number 3, is your bifurcated method the best way to tax portfolios that mix derivatives and non-derivatives? The one that they have for straddles and the one that they had for hedges, and couldn't we just have one system? Number 4, are you sure you've gotten right which instruments should be subject to mark-to-market? The definition of derivatives has been greatly improved from CAMP 2013 to CAMP 2014, but there's still uncertainty whether some contracts like repos and securities lending fit into the derivatives camp or not. How should the derivatives be taxed when one counterparty is outside the US? How do we live in a world when derivatives and the underlying are taxed in different ways? And have you thought whether book tax conformity might be the best solution to all of this, the same way you did book tax conformity for hedge identification? Now I'm going to be the devil's advocate and say that a theory with unanimous support is probably flawed, which is true of mark-to-market too. Perhaps we should get rid of all tax fictions like accrual, like depreciation, and mark-to-market, and just stick to cash. That's at least provable, findable, and objective. Or so we thought until Bitcoin was invented.
Yeah.
Some people in the Capitol, where I work, are disappointed that Dave Camp didn't introduce his magnum opus onto the floor of the House of Representatives. Aren't lawmakers supposed to enact laws? But in raising their eyebrows, these observers have revealed Camp's real genius, and it isn't in the words of the excruciatingly detailed reform he released as a mere proposal. It's found in the singular title, Proposal. You have to admit it's odd. The Ways and Means Committee isn't normally in the role of think tank. Big ideas come from academics, from the President and Treasury, from the tanks paid to think. But when Dave Camp became chair of the Ways and Means Committee after 20 years in Congress, he had 4 years to redo the tax code, and he would have to do it with whatever resources he alone had. The vision was his, alone. And his achievement was making it a shared vision using new methods. No flash in the pan, no fly-by-night, half-baked ideas from Mr. Camp. He's a litigator, and he knows that to win, you have to be the best prepared. He was a junior member on Ways and Means when welfare reform failed twice before it was signed by a Democratic president. Big ideas can't just be thrown onto the floor of the House of Representatives with the prayer that they'll stick. Hiring a dedicated staff of reformers and harnessing the House Legislation Council and the Joint Committee on Taxation, Camp began the journey to the 1,000 pages of reform with 3 goals: reducing rates while keeping distribution and revenue neutral. It's an almost impossible task. But it happened. Mr. Camp has released a complete reform package, including legislative language, revenue tables, and a technical explanation. I don't think any chair of the Ways and Means Committee has invested so many resources in such a manner, without any promise from the White House or Congress that they'll support him. People call to tell me, in secret of course, that if the proposal were enacted into law tomorrow, it would work, and work better than the code does today. But Mr. Camp's procedural innovations are greater than the technical ones. Throughout the process of creating his proposal, he was open to the ideas of anyone who really believed in tax reform. Regularly briefing the members of this committee, he took on the role of educator, explaining the trade-offs and reminding everyone that to reach good goals, there have to be sacrifices. In the several hearings held before the final release, members and stakeholders observed the working out of hard decisions needed for reform. And in the final product, we got to see the law as it might be, before the markups and the battles in committee. And now it will sit and be improved upon. Already people around the world are taking note. The United States has written words to implement the acknowledged ideal of the taxation of derivatives. Antibiotics and personal computers and iPhones and Google and Facebook were created in the United States, and now we have the most innovative model for the taxation of derivatives. Well, not quite. It hasn't gone to the committees or the chamber of the House of Representatives or the Senate or the White House. Heard melodies are sweet, but those unheard are sweeter. Therefore ye soft pipes play on. John Keats, Ode to the Grecian Urn. Thank you.
Thank you, Viva. Nice panel. Okay, here we go. You can feel free to engage each other. And we have handheld microphones here. For anybody who wants to talk, just raise your hand and we'll get them to you. And just a reminder, please tell us who you are, because it's being taped.
Can I just interject a little thing about the bifurcation? Because I was sort of, since I'm a 700-year-old vampire, I was there. And bifurcation, when we decided, so to speak, against bifurcation, and this was while people were working on the OID rules, and this, that was people don't realize that, 30 years ago, that was a big hurdle to get people over, is just understanding that accrual, which we now regard as, fairly simple compared to this. But the idea, though, thou shalt not bifurcate, was just a completely ad hoc decision made by the then, IRS and Treasury officials at the time who were not steeped in this stuff. I mean, they were sort of a little at sea with the OID rules, and so bifurcation was like, oh, no, we can't do that. No. Because people on the outside said, well, you could bifurcate stuff into any old group of things, which, we're using bifurcation in financial accounting, and people can price stuff. You can price, even Camp recognizes you can price stuff on a residual method. So, and Camp also says, if you can't really bifurcate and price them both, then mark the whole thing, and we know we can do that. So, it's not like there's some, biblical prohibition against bifurcation.
I want to make two comments, on what Viva said, and first, one point that I think we all agree on is book tax conformity would definitely help. But I do want to talk about 2 points. First, the comparison to OID is probably really apples and oranges, because yes, OID was revolutionary, and I agree that sometimes OID would require someone the holder to recognize income without actually receiving the cash. But when you think about magnitude, OID normally would not get the holder bankrupt, would not be in a situation where the holder would not be able to have resources to not pay the tax on the 5% or 7% return that they receive on the debt. Derivatives may. If someone does not have the funds, and again, I'm not a big supporter of the liquidity argument myself, because I believe that, as I mentioned earlier, that Congress basically dropped this whole liquidity concern a long time ago, but I would still caution that there would be situations where, especially in derivatives, and especially the ones that we know can move up and down very easily, that there might be situations where we would, whoever has to pay the tax on a derivative, not necessarily liquid. Not all derivatives are Enron's derivative, and a lot of them are privately negotiated. We gotta get it to our head. We're not just talking about all these big dealers that we really think that they should pay their fair share of the tax. They're already paying their fair share of the tax. They're already marking to market. Think about moms and pops kind of derivatives. If we mark everything to market, and the position is, yeah, there are such things as moms and pops derivative. What about convertible debt? What, don't you know that many people have in their portfolios convertible debt? They may not even know that they have convertible debt in their portfolio.
Well, then maybe they should
But the
know.
dealer is giving them a mark under the under the broker rules if they're retail.
But let's live in reality. Yes, they should know, but they don't.
But the broker rules are working. That is the reality on the
broker
retail side.
rules do work, but it's a step forward, definitely. But I just want to mention again
You can't argue that if you don't know what you've got in your portfolio, that's an excuse for not implementing a fair tax. I mean, that's really absurd. I would agree with you that there is a problem with if you have a massive portfolio, which no mum and pup should have, and if they do, they shouldn't have it. That if you have a massive portfolio like AIG had or Goldman Sachs, that you could bankrupt yourself. But perhaps If you have enough derivatives that the tax is going to bankrupt you, you shouldn't have that many derivatives. I mean, I don't know how else to say it. If this could be another form of regulatory control, that the tax is requiring you to record the fact that this portfolio is too large for you to manage.
I agree.
Yeah, yeah.
I agree. This is why, if we look at, again, I didn't, it's not just my invention, as I said, it's basically what most commentators are saying. Let's step back for a minute. Let's start with really the users of derivative, where we're talking large volumes, we're talking publicly traded derivatives, we're talking large users, we're talking situations where it's easily valued and liquidity is not necessarily a concern. And let's test these rules. And if these rules work 5 years from now, expand them a little bit. And then maybe in 20, 25 years, we will again reach a situation where everything works, but we got to move it in step. Now,
the greatest lobbying against derivative is coming from the exchange-traded markets, not from the over-the-counter markets.
Yeah.
The people who hate it the most are the exchange-traded people. I have not come across, because the over-the-counter people are mostly marking anyway.
Yeah.
It's the exchange-traded people who don't want to do it. So there's no question of valuation for those people,
Yeah.
and I'm not even sure there's question of liquidity. They just don't want to do it.
Yeah. On the exchange traded stuff for the rest of the audience, a lot of interest rate swaps, which is a very common thing that businesses use for hedging. Those things are cleared and traded and standardized, and they're easy to deal with. They also have low margins for dealers. Credit default swaps are also standardized now. And so we can price those. When we look at the London whale thing that happened at JP Morgan, that was in a credit derivative that there's a price for, because there's a firm that's just devoted to giving public prices for those things. But yeah, it is kind of interesting, the liquidity argument, because you're really making a tax argument out of what should be a regulatory argument that if you're going to go bankrupt on this thing, you really should not be in the contract. I mean, I just find that, I don't think that if we're going to have that, we need to have that discussion. We did not have that discussion in Dodd-Frank. We just said you get to be in the end user category and you don't have to margin. There should be suitability rules for end users. There should be some people who are not allowed to have something that isn't traded and cleared, and that was sort of what Dodd-Frank was going for. But yeah, I can't believe that there's somebody who's that unsophisticated, and I've got a big dealer on the other side writing a custom-made derivative for them. I mean, so somebody shouldn't be in that transaction.
Okay, so I think we're all in agreement then there need to be a reevaluation that, for example, if someone wakes up tomorrow morning and said, okay, let's implement CAMP, then we'll still have to go through phases of, as we said, maybe there is a need to actually educate those less sophisticated and say, maybe by virtue of, as I said, as a proposal, not just me, everyone else proposes, let's limit these two situations where most likely both parties are well informed. Educate those less sophisticated. See if the system works. And if it does, keep expanding. As Lee mentioned earlier, we're creeping there. I mean, it's there. And again, I'm not against, obviously I've been proposing mark to market. I'm just trying to make a point here that there's some instruments, some situations that as of now should be left on hold and to be reviewed, and not just saying forget about it. Even on the
So give me an example of how you would implement your policy. So you would individuals shouldn't be subject to market. Is that what you're saying?
No. What I would say is this: we're going to have to first test the system, and the best way to test mark to market is to start with the easier parts, which is let's mark to market all these positions that are easily valued, and let's mark to market the position, even if they're themselves easily valued, then the underlying is publicly traded and easily valued. And as I mentioned also, we should mark to market any time where someone is marking to market for book purposes, and this again will require confirmation by in regulations that you could do complete, full, unequivocal book tax conformity and not start imposing caveats that will then make it more complicated. So if we're marking to market, if we're applying book tax conformity, if we're marking to market publicly traded positions or when the underlying is publicly traded. And the system works for a couple of years, then this is where the next phase would be. And you can actually have individuals marking to market.
Well, I said, Jon, that the biggest objection to mark-to-market has come from the actively traded derivative markets. So in fact, today, we don't have a whole lot of stuff that's not on some market. Because of Dodd-Frank, most stuff has been thrown onto a market, and the issue of whether something's actively traded or not is less important than why the issue of I don't want to do it because it's not convenient, it costs too much money in the interim. I don't think the active trading is, and I think it's going to become less and less important as more and more things go onto markets. The market itself is not a protection against people who don't want to mark to market.
Well, I'm trying to understand, again, you both said that the biggest objection from mark-to-market come from exchange, like from what exactly you mean?
A cleared interest rate swap.
Well,
actually,
firstly,
the option industry is extremely...
And they've got marks. They've got daily marks.
Aren't these really marking to market already?
They have daily marks, yeah.
But individuals do not mark to market their equity options, for example. So that's obviously a market that has clear marks. There's no question about what it's worth. They're generally relatively short term, and there's enormous opposition to the implementation of Camp's proposal in that. And so the issue isn't the underlying or the derivative itself not being traded. The issue is that they don't want to do it.
Yeah, because what options have become, because the tax law, well, two things about options. In the real world, options generally don't cross taxable years. In the business world, like if I've got land and a shopping center developer wants it, but he doesn't know he wants to buy it, he wants an option. I'm not giving him an option that lasts 5 years. He's going to get an option for a few months. Make up your mind whether you want to buy this or not. You know, it's sort of the tax option, as it were, the option that crosses taxable years, that gets open transaction treatment, and it only gets open transaction treatment as sort of a historical anomaly. We were just negligent and we couldn't figure out how to do it, and we couldn't figure out whether we wanted to load in interest charges on this thing. You know, that's just been hanging out there. And so Camp is saying, yeah, market, you know, let's stop fooling around here. And then when you get to the exchanges, like Viva is saying, we got marks. And Camp is also, you know, a big group of option holders that would be a politically powerful group. The executives, he's taken compensatory options out of here, so that takes that group lobbying against it out there. So what would you be left with? You'd be left with actually a relatively sophisticated holder who's doing it for tax. Yeah, because if they really want to buy the thing, they're not doing, you know, a long-dated option. It's a tax play.
I'm still trying to understand, again, those what we're saying about who objects to it. And the reason is that, well, let's put it this way. If someone objects to market and they're marking to market anyway, I don't care about what they say or not. I mean, we're now talking about those that are not marking to market and what are their objections. So if someone's already subject to market, by the way, as I mentioned earlier, and I think many people in the audience will agree with me, actually we see more and more and more in the context of traders that actually do elect mark-to-market. They want to go into mark-to-market. It makes their life easier, so it's definitely a move in the right direction. So maybe, again, I'm not getting all the point, and again, maybe, again, Viva in her position right now get more the comments, so perhaps I'm not aware of all these objections, but my impression is that whoever is already marking to market, they can say whatever they want. It's not, they're already marking to market as dealers. Many traders today in securities elect marking to market because they understand the benefit of mark to market. They've been doing it for books. They need to adjust for the valuation, but they'll eventually get it. So expanding right now based on what Camp is suggesting, this is what I suggest as well, but the fact that people do object, people that already subject to market, I don't think is, in this case, is an argument for why we should actually make this thing even broader. We should rethink where to stop and at what point this should be, again, non-practical. And I keep talking again, and I think I mentioned it, so if tomorrow morning Congress wakes up and decides to mark everything to market based on Viva's proposal, which, again, is something that has been, again, discussed by everyone, by commentators, economists, tax professionals, tax professors over the years, then what it's going to leave us with is a lot of uncertainty and a lot of, what's really important, compliance burden.
Well, but the law today, Yoram, is an unbelievable compliance burden. Having a different rule for every single instrument and every single taxpayer. I mean, when you say clients call you and ask you about valuation, but you have a vast, larger number of clients calling you to say, what on earth does the contingent NPC rules mean? And how on earth do I deal with a variable prepaid forward versus an ordinary prepaid forward? And how, I mean, the idea that valuation is a bigger problem than the current tax system is not possible. And if it is, it's because it's a new problem. If you have a system that's been built up by the accountants, by the risk management people, by the valuation people, you've got an entire industry wrapped around valuation. The idea that that's a harder problem to solve than the current mess of the tax system, which you yourself said is a mess, I can't believe that. I simply can't believe that you have one problem that is greater than the accumulation of tax problems in the system right now.
So I agree with Viva again. This is the current compliance costs are enormous. So I guess one thing I would agree is that if, and to the extent, the implementing a comprehensive mark-to-market for derivatives would be proven to actually reduce compliance cost, comprehensive as much as possible, yes, definitely go for it.
Well, there's no way to prove that it's going to reduce compliance costs before it's come into the law. All we know is that it's one problem, which is valuation, versus 1,000 problems, which is current law. There's no way to prove compliance costs. We try. I mean, the various bodies try and do that, but there's no way to prove it. I mean, you have to take it on trust that you have that mark-to-market works for dealers and securities. It's worked very well for 1256. Everywhere it's been implemented, it's worked very well without any pre-trials. Like 475 had no pre-trials, and it went on live, and it was fine. So I don't know that we can ever prove that this is going to be a better system than what we've got today. All we know is that it's one problem versus 1,000 problems. So that, as a matter of rational logic, seems to me a lesser problem. Even though, of course, there's going to be some, the transition issues are going to be there, but all change in law has transitional issues. And it may be that some laws are not worth changing, but this area is such a messy area, as you yourself said several times, that it's hard to believe that changing to a singular rule is worse than than having the current system of a lot of rules. But it's a matter of faith or of logic. It's not a matter of something you can prove.
I guess I would add just one comment, but that I agree again that it's replacing one complexity with the other. But, you know, in a couple of months from now, I'm going to become a voter. And if Congress makes changes without at least trying to evaluate, I don't want to vote for Congress. Seriously. If what we're going to do right now said things are a mess, but let's fix them with something that we don't know whether it will be better or worse, this is not the way. This is not the way to work. There's got to be, this is why, again, and I keep saying I'm all for mark-to-market. Let's do it in steps. Let's study. Let's see how it works. But if we're changing one mess with the other, and by the way, once again, 475 is narrow, is limited. So comparing how 475 worked with comprehensive marking to market, it's, once again, it's not even apples and oranges. It's a pea with an elephant.
The moment the mark-to-market, the mark-to-market does not apply to any kind of hedging transaction, which is a vast majority of what normal FX and interest rate swaps will fall under the hedging transaction definition. So that puts that aside. There are other quite significant exceptions to the rules. So when you're saying it's compared to P to this, actually the mark-to-market on 475, and I don't have the data, but I'm sure we could easily get it, mark-to-market for dealers and securities is a much greater implementation because the vast majority of derivatives are done by dealers and securities. Nobody else, there's not much else going on. It's mostly dealer-to-dealer activity. So I don't agree with you at all. I think that was a far greater change than the change that Mr. Camp is now proposing. That was, in some ways, that paved the way with its extreme effectiveness. Besides Bank One was one case. It's all we've had is one case on that. Was a very old derivatives world. So we've had one case. Everything else is more or less worked out. And guess what? As I said, get it wrong and correct it the next year. Yeah. So I think in terms of numbers, the dealer and securities are far larger amount of derivatives than everybody else put together. I think anybody else in the audience, I'm willing to listen, but I'm assuming that that's the case.
Well, yeah, and Bank One was really a substantiation case. The taxpayer had not proved the values that it wanted to use in court, and it should have been just tossed out on that. It really wasn't an occasion for, a court, telling us how to value derivatives. And the other thing that would sort of give, because you're basically positing a situation where I've got a hedge fund that's, arguably supposed to be sophisticated, and certainly in our securities laws limited to sophisticated investors, holding level 3 derivatives. Because, we're pretty clear we could price level 1, we could price level 2. Okay, so you got level 3 derivatives, and the rules also say that when you're valuing anything, you got to take counterparty credit risk into account. And the other direction that accounting is moving in is allowing people to value things at net exposure if they've got a hedge book, which that is what hedge funds are supposed to have. I mean, I just find it kind of preposterous that you've got somebody who's supposed to be sophisticated. They've got a level 3 asset that's going to blow up in their face and just blow them up all over the place if they have to market for tax. I mean,
right. They've got more problems
their
than tax.
counterparty, if they were that unsophisticated and they were going to blow up their counterparty, wouldn't
Right.
be dealing with them.
I mean, the tax is really just a
The
little
tail
part
on
of
the
it,
dog
yeah.
here, because and that's what we're dealing with Dodd-Frank too is a failure to complete the sentence. We said what Dodd-Frank did was it took a situation that banks and shadow banks had got themselves in, and it said we're gonna have new rules to make all this safer instead of just flat out saying some of these activities are so dangerous we're going to have to make them illegal. And the next time things blow up, some of those things are going to be made illegal. But for now we've got this kind of bizarro premise that some of this stuff can be made safer. But if you're sitting there saying to me, yeah, this stuff is so unsafe that whoa, if we value it, it will be awful. I mean, that's that's got to be a question for the regulators too.
Do we have any questions from the audience?
Actually, sorry. I'm Phoebe Mix, and as somebody said, I sometimes call myself a housewife from Northern Virginia who dabbles in derivatives. And so my question is that just with respect to the case you're positing, which is the built-in the hedge fund that is going to owe so much money, but it's only going to owe so much money because this thing is worth so much according to their valuation, right? If it's got huge built-in losses, that's not what's going to blow them up. And so are they guilty here of wistful thinking? And perhaps they might call the counterparty and ask if the counterparty is willing to let them out for these obscene sums of money that they have valued it at, and that I mean, it seems a sort of odd.
Yeah, Phoebe, I think you point out something very important, which is that the good thing about mark-to-market is it lets you take your losses without selling your positions. That's a very powerful tool for taxpayers that aren't otherwise able to get out of their positions. The government says, we will let you take your losses, and we will give you credit for that. So
right,
I think that's important.
But this is the case that Urim is positing is the one in which the hedge fund is going to, if they've got $1 billion gain that somehow they're going to have to pay taxes on. But I venture to say that if the hedge fund were to contact the counterparty would not let them out for anything.
Phoebe,
close
most
to the
hedge funds are
billions.
already marking to market.
Right. So
We're
who's
not worried about hedge funds.
So who's the party with these huge gains?
That's gonna
Because the
bankrupt
only
them.
person who's going to be in trouble, you say, is the one who's got these huge gains that are going to catch up. I don't know. They're going to.
But also, why would they be bankrupted by the gains? That's, I mean,
No, they have to pay the tax on the gains. I'm assuming they're bankrupt. Aren't you assuming that they're being bankrupted by the gains, having to pay the tax on the gains? We're not talking about the fact that they're going under because the derivative's no good.
Phoebe, let me remind you that there are many mid-sized, small corporations, a lot of entities, not necessarily financial entities, that are into a few derivatives. Many of them actually use them for hedge. So you'll say, well, they're excluded. Not necessarily, because we know that hedging tax rules in the United States are limited only to ordinary assets. So there might be in situations where they have derivatives for risk management, not a tax derivative. Maybe there's a straddle, but there are quite a few not that sophisticated, not necessarily hedge funds that would have derivatives. The reason I don't talk about the billions. I can talk about the millions. But derivatives, as we know, everyone knows here, derivatives go up and up. We're not talking OID, where they're increment of 5% a year. That's why I jumped when I said derivatives can actually appreciate and depreciate in value significantly, and we don't need the billions of dollars to so that the taxpayer would not be able to pay tax. We only need a couple of millions of dollars in a company that is already living on. Again, don't think I kept saying liquidity is not necessarily my focus. I'm just saying that you are going to see situations where there will be holders of positions, not hedge funds, that have not been marking to market, that have built-in position in derivative. Remember also, as opposed to if you have a built-in gain in a security or even real estate that you can dispose of and pay the tax. Derivatives, in many of them, you can't even transfer them. You can't even transfer it. You can't do anything. So you have a built-in gain. Government tells you, write me a check. You don't even know what to do with this position. What are you going to do with it? Assign to a third party? You can't even do it. And again, this built-in gain would not be 5% from last year. It could be 50%. So I'm not worried about the hedge funds. I'm not worried about this. I'm worried about the mid-sized corporation taxpayers, maybe even individuals that do need these derivatives. Some of them may be for speculations, but many of them for risk management. They would not be tax hedges, but they would still not be able to pay their taxes on appreciated gain on a position that they can't even dispose of.
Do you think it's a wise thing for a taxpayer that can't manage the ups and downs and their derivatives to enter into them? If they genuinely
agree, I couldn't agree more. There need to be an education, and parties that enter into derivative need to know. Now, I'm not going to mention names of companies, but believe it or not, there are big companies. Some of them have been cited in the press as causing or part of the cause for all the financial meltdown in 2008, that their tax directors called us and said, I don't even know what I'm looking at, all these forward starting swaps. So yes, there will be even more sophisticated. They don't know what they entered into. Not everyone knows what derivatives are. Some of them knows, but they don't know, fully appreciate what position they have and what's the value of the position. And I sincerely fear that if this thing is not being studied, then we're just going to create, again, a bigger mess. So I agree with Viva. I do agree that people or entities that don't know what they're entering into, or even they know but they don't know enough about it, should be limited in what kind of derivatives. I think Dodd-Frank and the rest is going to the right direction. I agree, by the way, that a comprehensive mark-to-market will deter people from doing it. So I agree with that. But having said that, you can't just throw it out there and say, let people swim. You got to actually do it in steps.
So what you've got is you've got a problem that is not a tax problem, and you're sort of telling us, yeah, this is not a tax problem, it's a problem, and tax is just going to make it worse. That's sort of what your position really is.
Yes.
Because it's not a tax. It doesn't start as a tax problem. I mean, it starts like I started with my guy with his $300 billion book, but at least he was supposedly sophisticated.
Let me get to the audience. 1, 2.
My name is William Hoffman. I think you've pretty much come around to where I was going to bring this anyway. I mean, it seems like one thing that mystified me a little bit about the conversation was this assumption that people knew what was in their portfolios, or at least that they should, and if they didn't know what was in their portfolios, they shouldn't have gotten them in there in the first place. I mean, we just came out of a financial crisis that was populated by enormous corporations that had portfolios of unimaginable size, and they had no idea what was in them. They had been cutting up mortgage-backed securities. I'm not going to bore everybody with a replay of the 2008 financial crisis, but this seems to be, and again, you kind of were moving in this direction, it seems to move from a tax problem into a financial problem, and then the financial problem blows up and becomes a political problem.
Well,
And it seems to me that any discussion of mark-to-market at any level beyond what you call the mom and pop level is going to have to be, at some level, a political discussion.
Well, I think that if they had been marking to market honestly throughout the period that they owned this portfolio, honestly as in genuinely trying to do the mark, and if perhaps they'd been paying tax on the mark, they wouldn't have come to the point of coming to the blow-up in which they had these enormous portfolios that they didn't know how to recognize or deal with. But I think that if there had been some backstops, now I don't want to go into, I mean, what happened there was a combination of activities and non-activities. But on the other hand, if you have backstops reminding you what's in your portfolio, maybe you won't get to the point where you have a blow-up without knowing what's in there. It's extraordinary for anyone to say an organization as large as those who blew up couldn't have known about it.
No, but granted, but on the other hand, if they'd had those backstops and paying those taxes, marking to market, would they have gotten to that size in the first place?
Right, that's exactly right. This is a form of regulatory backstop, taxes.
But again, that brings it back to the political problem, because you're going to have resistance from financiers who are going to say, stay out of my business. I know what I'm doing. So what if I'm leveraged 50 to 1? Or 100 to 1.
Oh, no, they're only at 30
rules are on the
now.
verge of allowing now.
We're down to 15 and 30 in leverage now. It's much better. You know, we can all go to bed to sleep at night.
Maybe I'm mistaken, but doesn't Basel III allow up to?
Basel
I think it's
3
90
allows you to use your
95%?
own models to value stuff. That's it, just like Basel II. It's absurd that way. But the other thing is, Dodd-Frank doesn't make everybody in the world margin their derivatives. And if you had to margin this stuff properly, you wouldn't be in it either, because you would have to put money on the table. One of the problems with this stuff was it was a cheap bet. You wanted exposure to something because you thought there was going to be gains, even though the loss would blow up in your face, but you didn't have to put any chips on the table to make the bet.
But it seems to me that you're dealing in a world where there's another side that is always, on the one hand, pushing back, and on the other hand, advancing and evading any attempts at this regulation.
But they're doing that. But we've got, the dealers are marking now. We know that, and we know, which is why I would argue for a consistency rule that says my dealer has got to give my big company that you were looking at with the book of horrors in it marks. And if the dealer was just giving that company marks, maybe the company would start saying, "Gee, what are we doing in this? Why are we making these bets?"
One could hope.
One could hope.
One could hope. Over here? Oh, I'm sorry.
I do want to mention one thing just quickly, and again, going into tax policy, we started tax policy. There's it's been a discussion for many years, should the tax system be used to direct people's behavior, or just should the tax system be there to collect taxes? And we know there are views either way, but again, I'm not a big believer in using tax system to direct behavior. Even for example, the tax-exempt bonds, that not necessarily is the right way to direct people to put money into charities. So the question is really, and again, I don't think we're going to get the answer for this right now, but the question is really, how far do we want to use the tax system to exclude people from purchasing derivatives? So yes, it will be a result, no question about it. We know that when something is either provides tax benefit or a tax stick, then this is where there'll be some change in behavior. The question is really whether marking to market derivatives would be the right answer there to, again, reduce activity for those people that should not enter into derivative to begin with. And I said this is just a debate that has been going on for many years from a tax policy perspective.
You put all the politicians out of business. Well,
I'm Marty Sullivan with Tax Analysts. I want to thank the presenters for, I'm a newcomer to this area. This is all Greek to me, but it's extremely clear and informative and entertaining, so I want to thank you for that. I didn't think I would be able to understand all this. With that background, let me just ask two what may be naive questions. The first one's for Viva. So you're lobbied by exchange-traded funds that have actively traded derivatives, and they don't want to mark to market. And why? What is their excuse for that? And then my second question is, it seems that mark to market does create a lot of simplification in most cases, perhaps not all. why don't we, why is there a dividing line on mark-to-market between derivatives and all securities? Why is that policy, why do we stop there? And that might be a political question, but it also seems like a technical question when you have a portfolio filled with with just plain vanilla securities and with derivatives. How do you take them apart?
Let me dump out your second question in 2 sentences. The short answer is because we've always done it that way, but we've also got these, and that's the answer to pretty much everything in the tax law. But the other thing is we've got broker reporting rules now, and we are starting to see the vast simplification to a taxable investor's Schedule D that the broker reporting rules have. So once you've got those numbers, you can mark listed securities to market with no trouble, and we can get there. But politically, we're all supposed to think that there's grandma with security certificates under her mattress, which is not the case either. So, but let's let Viva answer the other question.
I just want to point out that this was not a singular proposal that was put out there by Mr. Camp. It was part of a very large project, which I talked about, which is trying to reduce rates and do so in a revenue neutral and distributionally neutral way. And so that's the big picture here. This is a tiny part of that, as everyone in this room knows, and the decisions that were made to get there were compromises at all levels. And that's Mr. Camp's achievement, is to point out that if you want to do things in the tax law, you're going to have to make compromises, and they're going to be tough ones. And this is why. Anyone who's in the system now, in other words, anyone who's successful enough to get their transaction going has got some advantage. And when you take the advantage away from them, when I was at the Treasury Department, I worked on a very small provision for like-kind exchanges, in which we were going to tax the interest portion of qualified intermediaries. I mean, it was so deep in the weeds and so technical that you barely could understand it. It was about just imposing interest. Anyway, the qualified intermediaries were so outraged by the fact that they were going to be taxed on the interest portion of what they owned, because the entire industry had developed around the fact that this wasn't a taxed activity. So, it doesn't mean it was that the activity should have existed or whatever it is. Entire industries develop around the fact that they're not taxed. So you have to remember that. There's no necessary rational reason when you propose to tax something, when you propose to tax something, that somebody who hadn't been taxed before is now being taxed and gets mad.
So just again, as somebody as a newcomer to this, maybe what you all haven't said is that trading in derivatives is a tax-favored industry.
Well, that's
and I didn't know that.
Yeah,
On the customer side, yeah.
and
And there's the anomaly between the mismatch between the customer and the
and
dealer.
you would be
who is
taking that
market.
away with mark-to-market.
That's correct.
Yes.
First of all, the character, I mean, we haven't discussed character at all right now, and the character is the key here. We are going from a potentially long-term capital gain character situation, which is elective for people entering into derivative as long as they hold it long enough, which is a tremendous advantage. And then you're going to an ordinary income. Doesn't matter how long you hold the thing, you're going to ordinary income for 1256 contracts, for example. So when you say to me, what's going to happen? 1256 contracts, which now even if you hold them for one day, you get 60-40, 60 long-term, 40 short-term, you're going to go to ordinary income. So you can imagine it when you say what happens at the exchanges. They're not really happy about that. They're going to lose that tremendous advantage of having a long-term capital gain. So I think, Mark, the timing aspect of this is far less important than the character aspect. And as long as we have in the code this tremendous gap between ordinary income and capital gain, a change is going to make people unhappy.
And if I may, since only very sophisticated players can do this, this is, or not?
I'm going to have to interject one more time, because the whole notion that derivatives are so bad and they're being used for tax evasion is kind of misleading. Yes, there were plenty of opportunities to beat the system using derivatives. Maybe we're all talking about 871M and equity swaps. But let's just put things in perspective. For every derivative, there are two parties. One of them is a true dealer that's just trying to make a living and just get a few basis points as a spread. The other party may well be someone that's trying to hedge, but unfortunately, it's not a good hedge for tax because they're trying to hedge even a capital asset
Okay.
that unfortunately Congress never took the opportunity to say, let's just do book tax conformity for hedging. So yes, I agree that there have been derivatives and some of them actually provide tax benefit. Yes, but also there are plenty of derivatives out there that are done for valid business. Now, the other thing I would mention, we mentioned Section 1256 was added to the code in 1981. This whole 60-40, which again is a benefit obviously if you're on the gain side, if you're on the loss side, you're not on the benefit. So for every derivative, there are two parties, and if the derivative is perfect, there's one gaining, there's one losing. So if someone has capital gain, the other one will have capital loss. Now, I'll mention 1256. Before we go into comprehensive mark-to-market, let's get rid of the 60-40. Why do we need a 60-40? I agree with that. Let's get rid of it.
Because we can't do any kind of change without comprehensive reform. That's obvious.
No, 60-40? Why can't
We
we
have
just...
60-40 because of Chicago. But period after that.
I'm not talking about derivatives. I'm talking about the fact that you can't get anything through Congress. Any change that takes away a benefit from someone doesn't go through Congress unless you do some kind of comprehensive change. I mean, there's no secret about that. What benefit has been removed from someone without unbelievable pressure? So when you say take away 60-40, I was working at the Treasury on one Friday night in the summer, so nobody was there except for me, and nothing was going on, and there was somebody introduced onto the floor to remove 60-40 to 50-50, not to get rid of it altogether, go from 60-40 to 50-50 within half an hour. I had hundreds and hundreds of things coming into my inbox. There was an entire avalanche on a Friday night in the summer. So you can't take away any advantages in this world unless you do it in a comprehensive way.
Hold on. Personal example. Until 2 years ago, I got $5,000 of, what do they call it, medical flexible account. Then what do we have now? $2,500. Who took it away from me?
Congress.
Congress. $1,000 less in my pocket every year? It's significant. So, yeah, you can take benefits away from someone. Congress can do it. They've done it. No one even felt, no one cares. I do. It's a less $1,000 in my
You
pocket.
weren't voting.
Oh, yeah.
This is the
Yeah,
thing.
correct. But yes, let's put things, yes. 60-40 can be changed. I agree that it should be part of a more comprehensive, but if we consider 60-40 as a benefit, 60-40 could change. We could change 1256. Yes, it will raise a lot of voices, but this could be a first step in simplifying the tax system. Now, what about the capital gains preferences? What about 15 to 20%? Yeah, all these things certainly could simplify the code if we get rid of the capital gains preference. If everything taxed is ordinary, of course it will raise a lot of voices, but it has been done before, could be done. So yes, it should be part of a comprehensive, but the fact that right now taxation of derivatives is subject to all these uncertainties, as I mentioned in my paper, doesn't mean that we got to go all the way. Maybe we should, after we study, after we do it in steps.
Why is going in steps better?
Because it allows to evaluate, to assess, instead of throwing something like FATCA or anything like that no one knows how to even, digest this monster, let's do it in steps. I agree, we need mark-to-market. This was the gist of my paper.
But there's very strong evidence that going in steps causes people to come up to the line every time and creates more discontinuities. What Congress does right now is go in steps, and it doesn't work. It creates much more complexity. It's better to leave it to do nothing than to go in steps. Actually, it's better to start from ground zero and say we're getting rid of all the rules of derivatives and have whatever regular common law rules than to go in increments that don't allow for simplification.
And doesn't it matter which taxpayer you're taking it from, or which industry you're taking
Yeah.
it from?
Yeah.
Because itemized deductions and personal exemptions just disappeared for people. And
Right.
Yeah. I think getting back, let's get back to your Mittelstand for a second. You're telling me they've got derivatives that are cash flow hedges and Hoover hedges, right? That are capital to them, right? Dealer's market on the other side. But this instrument here is not going to qualify for hedge treatment for tax, right?
Yeah.
Yeah. So another thing you're saying, because my Mittelstand are not speculating, right? They're doing this for some risk, even if it's just, they're a furrier and it's weather, right? Which is a completely reasonable thing for a furrier to be doing, right? Okay. So what that says is, first of all, we've got to get rid of the discontinuity between capital treatment for that person and ordinary treatment on my dealer's side. But it also says that we got to go, and I've been screaming about this for years, we got to go to the financial accounting definition of hedges rather than the tax law definition, because the tax law definition is screwy in two ways, okay? You're allowed to say whatever you want is a hedge, even if it's taking a flyer on something, and you're not allowed to say things that financial accounting thinks are genuine hedges, like Hoover hedges and like cash flow hedges. Like a Hoover hedge is a hedge against the risk of your subsidiary. You're not allowed to say things that are really genuine. I'm really trying to offset the risk of holding this asset that I must hold, or this cash flow because maybe it's in a foreign currency, although we have some helpful foreign currency rules. What you're saying is we gotta import the financial accounting definition of hedges. And really, when you look at the Camp, when you want to talk about gradualism in the Camp proposal, when Camp says, oh, well, shit, if you identify, sorry about that,
I'm surprised
from
it took
New
you this long
York,
to get to it.
Everybody up on this stage has either lived in New York, lives in New York now, and it's a wonder we got through this.
Or was born in New York.
Yeah, okay, fine. But here's what Camp is going to do, and this has been pointed out. If Camp says if you already identified it for GAAP, you're deemed identified for tax. Well, all your Hoover hedges and cash flow hedges are identified for GAAP. So, he's not saying you can just import your GAAP hedges. He's saying you still have a sorting process, and any sorting process is complicated because your accounting people in your accounting department are going to say, oh, just let me import the GAAP numbers and shut up about this. I'm not going to sort out the other hedges here. So what Camp is doing is he's really setting up to get this definition changed. Because, and when you get right down to it also, the tax definition, which we have in regulations, that was ad hoc too. Oh, just tell us you got a hedge. But our tax case law says you can't have a Hoover hedge in tax.
Okay, we've got about 10 minutes left, Max, and I got one question in the audience, and if I could get to this one before, because somebody from the virtual audience sent this, and I hope I get it right. Shouldn't tax benefits or loss derived from derivatives be accounting disclosure to shareholders in each 10Q? They are?
That is what they're in the income statement. If you're a reporting company, you're required to mark your you're required to mark all your derivatives. That's topic 815 and topic 820. It goes in the income statement.
Okay.
So again, I agree. If someone is subject to reporting and there is a 10K and their numbers are reasonable, then let's have this person mark to market. Yeah, I think we're all in agreement there.
Okay.
But not everyone, unfortunately, gets this benefit.
Back in the back there?
Hi, Luca Tonicelli. I'm one of the Capitol Hill reporters for Tax Analysts, and so although I'm a reporter in this case, instead of asking a question, I thought I'd offer a couple of thoughts on the politics and congressional outlook for this. This is something I've always wanted to say. In this case, I think I'm going to agree with the lady in red, because if you look at the number of tax bills and just bills in general that have gone through both houses, both chambers, in the last year or so, I mean, it's not very many, especially not tax bills. We find ourselves writing mostly about tax reform for that reason, or partially for that reason, also because it's important, apparently. And so in this case, you were just asking, why is it that I have this reduced benefit of thousands of dollars, but this thing won't budge? Well, the difference is all of us have that reduction in benefit, and how these things tend to work is that...
No. Some people don't
Let him
spend,
finish,
others
let him
more.
finish.
No, don't say all of us. Don't say all of us. Continue.
Those of us who
No.
have jobs, I guess. Which, by the way, couldn't be thankful enough, Chris.
How many people don't have health insurance here, and this is why you did so? Let's put things in perspective.
Okay,
Continue.
well, thank you.
Don't say all of us.
Thank you for the perspective.
Okay.
So the reason that that diffuse benefit was lost, but this concentrated one is endlessly retained, is because it's concentrated, and because my guess is the people who are advocating for this treatment of derivatives are pretty well bankrolled. That it's really hard from a public choice standpoint or political economy standpoint to budge that sort of thing. Whereas if you have something that's spread across a much larger constituency that's less likely to understand the benefit or pay that close attention to it, I mean, it's just it's the concentrated benefits, diffuse costs kind of narrative. That's what I see at play. So, although I don't necessarily think that this sort of thing, if it were to move, would have to move in a comprehensive bill, I think it would have to be as part of something larger. On the other hand, I will note that Camp's bill demonstrated a willingness, at least on his part, to tempt the outrage of the banking industry with the bank tax. So really it could go either way. I mean, that's my disclaimer. I mean, if I could predict what was happening, I wouldn't be a reporter, I would be an oracle. But I hope you guys see my point.
Okay. Anybody else have any questions? Okay. Any further comments, folks? Okay. We'll wrap it up then. A couple things here. You can tell tax analysts we're passionate about tax. Now, in another room, which is which way, that way, we have set up a reception because the way I think of it is the way the tax system handles derivatives drives you to drink. So please join us over here. And let me get my thank yous out. First of all, thank you to the wonderful tax analyst staff who made this very comfortable and very easy for all of us. Thank you to our excellent panel. I thoroughly enjoyed the discussion, and it looks like just about everybody else did too. And thank you to our guests, the most important part. I'm done.